Title: Understanding the Cycle of Financial Crises, Lessons from History. Introduction: Welcome to Simple Mind Space, the podcast that helps you master your money and your mind. In today's extended episode, we will explore the main topic of understanding the cycle of financial crises by delving into historical events and drawing valuable lessons for today's world. We will examine the tulip bubble of the 1700s in the Netherlands, the stock market crash of 1929 in the United States, and the subprime mortgage crisis of 2008. By understanding the causes and consequences of these crises, we can gain insights into the current state of global markets and make informed financial decisions. So, let's dive into the fascinating world of finance and history. Part 1. The tulip bubble of the 1700s in the Netherlands. In the 1700s, the Dutch were a powerful nation with a dominant trading company called the East India Trading Company. The Dutch, mostly Calvinists, were forbidden from flaunting their wealth and luxury. However, they found a way to express their social status through tulips. Tulips became a symbol of luxury and prosperity, and their prices skyrocketed. This led to the creation of tulip futures, a contract that guaranteed the purchase of tulips at a predetermined price in the future. The tulip futures market boomed, fueled by speculation and the desire for quick profits. However, the bubble eventually burst, causing chaos and financial losses. We must learn from this historical event and understand the dangers of speculative behavior. Part 2. The stock market crash of 1929 in the United States. The 1920s were a time of great economic growth in the United States. Following the end of World War I, the stock market was booming, and people were eager to invest. However, this period of prosperity was built on a foundation of credit and excessive speculation. Banks were lending money to investors, who in turn were borrowing to invest in the stock market. This created a cycle of debt and inflated stock prices. Eventually, the market became overvalued, and when people started to panic and sell their stocks, the crash ensued. The stock market lost billions of dollars, leading to widespread bankruptcies and unemployment. This crash serves as a reminder of the dangers of excessive leverage and the importance of sound financial practices. Part 3. The subprime mortgage crisis of 2008. In the early 2000s, the housing market in the United States was experiencing a boom. Lenders were issuing mortgages to people with low credit scores, known as subprime borrowers. These mortgages were bundled together and sold as mortgage-backed securities to investors. The belief was that housing prices would continue to rise, making these investments profitable. However, when housing prices started to decline, many homeowners defaulted on their loans, leading to a collapse in the housing market and the financial institutions that had invested heavily in these securities. The crisis had far-reaching effects, causing a global recession and exposing the risks of complex financial instruments and lax lending practices. Conclusion. The history of financial crises teaches us valuable lessons about the dangers of speculative behavior, excessive leverage, and irresponsible lending practices. These events serve as cautionary tales for today's investors and policymakers. It is crucial to maintain a balanced and cautious approach to financial decision-making, understanding the risks involved and the potential consequences of unchecked greed. By learning from the past, we can strive for a more stable and sustainable financial future. Remember, financial freedom and success come from knowledge, discipline, and making informed choices. Thank you for joining us on this journey of understanding the cycle of financial crises. Please like, share, and subscribe to our podcast if you found this episode valuable. Stay tuned for more insightful content on mastering your money and your mind.